Good evening to all the participants. I welcome you again for our 120th webinar on behalf of Madras Tax Bar. Today we have N. Prasad, advocate, sir, who will be taking the who will be giving the talk on slump sale, the concept under GST. So we are looking forward to this session. After sir finishes his talk, we will have the discussion round where everyone can give their own opinions, or you can ask your queries also. So hope we have a great session today, and we're looking forward to hearing from sir. Thank you very much, Prasad sir. Over to you.
Thanks to the Madras Tax Bar. And this topic, I thought I'll basically divide it into 2-3 parts. One being the concept of an undertaking as understood by Supreme Court. Then a brief preview of judgments in the context of sales tax law with regard to transfer of business and certain issues which I thought may be relevant presently under GST regime. Now, undertaking per se, in the context of acquisition of undertakings, was first discussed by Supreme Court, elaborately in the case of R.C. Cooper, which is 1970 Supreme Court. And in paragraph 165 of the judgment, an undertaking was understood as an amalgam of rights and obligations and different types of assets, movables and immovables, and as Supreme Court put it, a complex weft which cannot be easily dismembered. Therefore, undertaking per se was understood as an amalgam of rights and obligations. This is 1970 Supreme Court in R.C. Cooper's case. Now, in the context of sales tax law, there has been extensive debate with regard to in what circumstances one could say there was transfer of business as a whole. So you may be aware that in sales tax law, both under the sales tax law and under the value-added tax regime, there has been an express provision for grant of exemption when there is transfer of business as a whole. Under the TNGST Act, we had section 2R, which defined turnover. There was an explanation to the expression turnover under section 2R, which exempted that turnover which arose as a result of sale or transfer of a business as a whole, as a running concern. Under the old 1939 Act, we had a Rule 6, which was present, which had more or less the identical language. Now, in the context of the sales tax law, and in what constituted transfer of business, certain principles have been well entrenched and are summarized in 2-3 judgments of the court. Those principles I just enumerate. A, any unit or business unit which has the capacity to operate separately and generate profits could be treated as a business by itself. That's principle A. B, a branch or a line of business can also constitute a business by itself with its own rights and obligations. 3, the consequence of principle 2 is that a transfer of business, a line of business or a branch with its own appurtenant rights and obligations will also constitute transfer of business as a whole. 4, it was not necessary that the goodwill of the business had to be transferred to constitute transfer of business as a whole. This may be important because though the statute used the expression as a whole, the court found it unnecessary that the goodwill also had to be transferred. 4. 5. the court drew a distinction between the business which generated the goods and the goods itself. Now, in a R.C. Cooper itself, though business per se was held to be property, from the standpoint of Article 31 and Article 91F, when it came to sales tax law, the court drew a distinction between business and the subject matter of the business. It said that when a business is transferred, it will not amount to a sale of goods which is chargeable to tax during the subsistence of the business. This is how the court put it. Then, transfer of business as a whole was not incidental or ancillary to the carrying on of the business. One could not bring it under one of the subclauses in the definition of business which referred to an incidental or ancillary activity. Yet another principle. It was also not an act done either in the course of business or in the furtherance of the business. These principles are now well entrenched in sales tax law and summarized in about 3 or 4 judgments. The first judgment being reported in volume 39 STC in the case of Thomas Behanan's case in volume 39 STC, page 325. The second case was a case of Monsanto Chemicals in volume 51 STC, page 278. The third judgment was a judgment of the Madhya Pradesh High Court, again a division bench, in volume 48 STC, page 447. And these principles were later on, much later, reiterated by a full bench of the Andhra Pradesh High Court. Justice P. Venkatram Reddy, as he then was, authored the judgment in a case called Coromandel Fertilizers versus State of Andhra Pradesh. And this is reported in volume 112 STC. So these are broadly the principles under the sales tax regime. Now, when one comes to the GST law, I think one can fundamentally pose oneself the question, is there at all a charge or liability on a slump sale under the GST regime? I think this becomes obviously the primary question before we move on to other issues such as retention of credit or method of apportionment of credit in a slump sale under GST regime. So when one looks at the GST law, CGST Act, illustratively, charge is under section 9 of the Act. Now the section 9 of the Act provides for a levy of tax on all intrastate supplies of goods as well as services. There is a definition of goods which is found under the GST law. There is also a definition of service. Service is defined as anything other than goods. Therefore, it seems to be some kind of a receptacle which can absorb something which will not fall within the category of goods itself. This may appear to be prima facie significant because in the case of Vikas Sales Corporation and then later on reiterated in Tata Consultancy Services, goods was ultimately understood as movable property. And from the standpoint of the General Clause Act, anything which was not immovable was found to be goods. Under the GST regime, we have a residuary definition of service. But to me, the more important question could be not whether it's goods or service, but whether there is at all a supply as defined under the Act. That's how it appeared to be. Now, when one looks at section 7 of the Act, which defines supply, because one, as you may have seen, read section 9 not in isolation, but with the definition of supply under section 7. Section 7 has various parts to it. And 7.1a was later on inserted in the year 2018, but given retrospective effect. That is 7.1 capital A. Now 7.1 small a which is in the commencement of the definition of supply. This supply includes all forms of supply of goods or services or both, such as sale, transfer, barter, exchange, license, rental, lease, or disposal made or agreed to be made for a consideration by a person in the course or furtherance of his business. That is how supply is defined under section 7.1a. The one view which has appealed to the advanced ruling authority on 2 occasions is that this is a supply. Even a transfer of business will be a supply. There were 2 foundations for the advanced ruling order. One was the inclusive definition of supply. The other was the fact that the government had notified it for rate purposes. Slump sale itself was notified for rate purpose as a supply of a service, though subjected to nil rate. These are broadly the foundations on which the advanced ruling authority has put it. But coming back to the definition, A is no doubt in inclusive terms. But in my view, the inclusion appears to qualify the type of supply and not the circumstances in which the supply will take place. 7.1 bracket small a has 2 parts. A, it has the type of supply. It refers to sale, barter, exchange, license, lease, or disposal. These are types of supplies. Then the finishing phraseology of 7.1 small a is for a consideration by a person in the course or furtherance of business. Therefore, for the purposes of section 7.1 small a, it has to be an activity in the course or furtherance of business. Now, the question will therefore arise, is this something in the course or furtherance of business? I'll come to that in a moment. I'll just exhaust the other parts of section 7. If you come to 7.1 capital A, there are activities which are set out in the second schedule to the Act, which can constitute supply, provided section 7.1 is also concomitantly satisfied. Now, if one comes to the second schedule to the CGST Act, there is entry 4. Now, entry 4 bracket small c appears to be 4 bracket small b may have some significance. Entry 4a says, where goods forming part of assets of a business are transferred or disposed or by or under the directions of the person carrying on the business, so long as no longer to form part of those assets, such transfer or disposal is a supply of goods by the person. Therefore, 4a per se looks only to the transfer of the goods, but the subject matter of the transfer is the goods per se and not an amalgam consisting of rights and obligations. So in my view, 4 bracket small a may have no applicability. Then 4b, whereby by or under the direction of a person carrying on business, goods held or used for the purpose of business are put to any private use or are used or made available to any person for use for any purpose other than the purpose of the business, whether or not for consideration, the usage or making available of such goods is a supply of service. So 4b focuses on the use of the goods and treats it as a service. 4c, where any person ceases to be a taxable person, any goods forming part of the assets of any business carried on by him shall be deemed to be supplied by him in the course or furtherance of his business immediately before he ceases to be a taxable person. So 4c, main part, before I come to the exclusion, the main part focuses on a case of sale of assets before sale of assets on the closure of a business. This is a situation which is more or less contemplated by a judgment of the Madras High Court in volume 12 STC in the case of State of Tamil Nadu versus Thermoset, where on closure of the business, certain assets were sold. The SSC wanted an exemption under the erstwhile Rule 6 of the TNGST rules, calling it a sale of business. That was denied by the Madras High Court on the ground that it's a sale which takes place on closure and it's only a sale of the assets. That's the main part of 4C. But then there is an exclusion. The exclusion is subclause 1, where the business is transferred as a going concern. Now, this is an exclusion under the schedule. Now, a schedule is treated as part of the Act. Therefore, one way of perceiving the whole situation is an exclusion found under the schedule, which is part of the Act, is an exclusion from the Act itself. Therefore, one of the arguments which can be submit that there is no charge or levy on the slump sale can be that 4C, the exclusion under 4C, is itself indicative of the position that there is no charge or liability on the transfer of business as a running concern. That can be one argument. Now, if one comes back to section 7, as I said, 7(1) bracket small a enumerates two things. One, the types of supply. B, the circumstances in which the supply is made. Now, the advanced ruling authority appears to have gone on the basis that the inclusion will qualify every part of 7(1)A, both the types of supply and the circumstances. In my opinion, that may not be so, because the entirety of 7(1)A is followed by a finishing part which throws its quality on the preceding expressions. Made or agreed to be made for a consideration by a person in the course or furtherance of business. Therefore, unless the activity is something in the course or furtherance of business, it cannot be subjected to tax. Therefore, even if one proceeds on the basis that an undertaking is service because of the residual nature of the definition of service, it may not constitute a supply for the purpose of section 7(1)A. Now, there is also another reason why 7(1)A can be understood as not encompassing a transfer of business. Now, these expressions which are found in the course of are not expressions which have been put here for the first time. These are expressions which have been understood by the court, which have come up for consideration for the court much prior to GST law and in the very early stages of the sales tax law itself. Now, if one goes back in this regard to some early decisions, one of the earliest judgments was in the case of State of Travancore versus Shanmugavilas Cashew Company. So this was AR 1954 Supreme Court, page 333. 54 Supreme Court 333 had to deal with the expression in the course of. Now, in the course of was understood, was an expression mentioned in Article 286 of the Constitution and also in earlier Section 5 of the Central Sales Tax Act. Now, Section 5 of the Central Sales Tax Act granted an exemption on sales taking place in the course of export. In the course of export was understood as not only meaning an integral link between the contract and the movement. Supreme Court broadly put it as a subsisting relation between two different subject matters. In other words, if there are two subsisting subject matters, then the expression in the course of offers a connected relation. Therefore, the use of the expression in the course of may indicate the existence of two subsisting subject matters. Therefore, when section 718 uses the expression in the course of, I would assume that Parliament is deemed to know the law declared by Supreme Court, and therefore is used in the course of the purpose. And the purpose being to indicate a connected relation between two subsisting subject matters. Therefore, on the transfer of a business, if there is no business at all, if that side and if that line of business is being transferred, putting an end to a business may not be a connected relation between two subsisting subject matters, because one of the subject matters ceases to exist in the hands of the transferor. Therefore, in my view, it appears that in the course of may not help the department. The second expression is, and in one other decision, in the context of in the course of, is of course in the context of the old gift tax law. This judgment is AR 1972 Supreme Court, page 23. The Commissioner of Gift Tax versus Varghese. Now, this judgment in the context of the gift tax law also said that to be in the course of business, the gift must be made in the course of the subsistence of the business. Therefore, in the course of, construed by Supreme Court on two occasions, may indicate subsisting subject matter, which in the case of a transfer of a business may not even operate. Now, the second expression is in the furtherance of. This is again an expression which has received judicial consideration. I'll give the decision in AR 1954 Supreme Court, which is 1954 SCR 774 in Liquidators of Prasad versus Commissioner of Income Tax, Liquidators of Prasad case. There, when the assets were sold on liquidation of the business, it was found to be an act not in furtherance of the business. Therefore, this expression in furtherance of is again an expression which has been understood judicially. And when Parliament uses that expression which has been judicially construed, Parliament must be deemed to be aware of the law as interpreted by the Supreme Court. Now, in the context of these expressions, I think the judgment in Paradise Hotels case, it becomes important. This Paradise Hotels case is now a reported judgment of the Telangana High Court and is reported in 2018, volume 16 GSTL, page 361, the judgment of the Andhra High Court in Paradise Hotels case. Now, why this judgment becomes important is this judgment dealt with the provisions of the Andhra Sales Tax Act prior to an important amendment. And also after the amendment, the provisions were contrasted. The case itself arose after the amendment, and the case of the department was built on the amended provision. So the Andhra section, which is section small Roman 30 of the Andhra Pradesh General Sales Tax Act, underwent an amendment sometime in between. And during the subsistence of the GST, Andhra Pradesh Sales Tax Act itself, until a particular period, the Andhra Sales Tax Act was more or less similar to the Tamil Nadu Sales Tax Act. Then an important amendment came, then an amendment came, then there was a judgment of the full bench of the Andhra High Court in quorum and fertilizers. It said that when you transfer the business, it is not an act in the course or furtherance of the business. Then came an amendment to the Sales Tax Act. This amended provision had yet another subclause. The subclause was to the effect that any act performed in connection with the closure of the business would also be business. The department relied on this provision and said that the transfer of business as a whole will be an act in connection with the closure of the business. This amended provision was relied upon by the revenue. It was held by the Andhra High Court that even after the amendment, there would be no charge of sales tax because an act in connection with the closure of the business will not encompass an act of transfer of the business itself. Perhaps the amended section could take in the situation which I mentioned in the case of thermostats case in 12 STs. Now, the reason the Andhra judgment in Paradise becomes important is that if one looks at the definition of business under the CGST Act, it has various limbs to it. Section 2 bracket 17 up to subclause C is more or less a repetition of the sales tax provisions. D is something similar to the amended sales tax provision which was considered in Paradise case. Therefore, 217D says supply or acquisition of goods, including capital goods and services in connection with the commencement or closure of business. Therefore, even if the revenue was to rely on 217D, perhaps Paradise can be put as a defense to say that the provisions and the definition of business as they stand are not wide enough to encompass a transfer of business. There is one more parallel with the CGST Act and the Andhra Act, Andhra Sales Tax Act. The Andhra Sales Tax Act did not contain an express charge to tax transfer of business. The Andhra Act only had a negative provision. It said there will be no input credit if there is a sum slain. From the negative provision, an inference was drawn that because of the denial of credit, there is no liability. That's one way of drawing an inference. The other method of drawing an inference is that if the provisions of the Act are inadequate to tax the transaction, tax the activity, charging provision, strict construction, language of the section, as it stands under the CGST Act, is not wide enough to tax a slump sale. That's the other way of perceiving the whole situation. So one question can be, can subclause small b be invoked, which is incidental or ancillary activity? Now, and now this argument was put forth by the revenue in the case of coromandel fertilizers. In the case of coromandel fertilizers, revenue made a couple of submissions. A, they said the transfer of business is an activity in connection with or incidental or ancillary. B, they said it's an activity in furtherance of the business. Furtherance of the business we have already seen. They also said it could be incidental or ancillary. So as to what is incidental or ancillary, there are judgments of the Supreme Court. Now, as Justice Krishnaiyer put it in 1988 Supreme Court, the judgment in 1988 Supreme Court as to what would constitute an incidental or ancillary activity, learned judge put it as incidental or ancillary means something which is appurtenant to a subsisting subject matter. It was a case which arose under the Employee State Insurance Act, 1988 Supreme Court, and his lordship, Justice Krishnaiyer, put it as something which appertains to a subsisting activity, something which should be incidental or ancillary to a subsisting activity, something which is the main activity and which is subsisting. Now, if therefore one puts the question, the transfer of business per se may not be something which is incidental or ancillary to a subsisting subject matter. And that's how the full bench of the Andhra High Court also held in this 112 STC, page 1, in the case of Coromandel Fertilizers versus State of Andhra Pradesh. Now, another question which was posed to the revenues, what could be the purpose of a slump sale? The purpose of a slump sale would be to assist a subsisting business. An organization can may find that the general profitability of the enterprise is going down because of an unprofitable division. Therefore, the organization, while deciding to retain Division A, can choose to transfer Division B. Now, is that in furtherance of the business of Division A? Was a question which arose before the full bench of the Andhra High Court, and that the full bench of the Andhra High Court said, you must find a nexus which is proximate and not remote. The fact that it may ultimately help the subsisting business is a nexus which is too remote to say it is in furtherance of the subsisting business. Therefore, the full bench of the Andhra Pradesh High Court took the view that it's neither incidental or ancillary, nor in furtherance of the business. These are broadly the reasons which I thought I'll give to perhaps suggest that there could not be an effective charge, may not be an effective charge on a slump sale under the GST regime. That's one part of the discussion. So, what then is the effect of the notification? We have seen that for rate purposes, there's been a notification which has been issued by the government treating slump sale or transfer of business as a whole as an exempted service. Now, the question will then be, should one go by the notification or should one address himself in the terms of the charge? Again, the line of judgments which I mentioned, the Madras High Court and the full bench of the Andhra High Court, 2-3 decisions, also hold. There also, the Madras law, sales tax law, we had Rule 6. Rule 6 contained an express exemption for transfer of business as a whole. Now, the division bench of the Madras High Court, whose reasoning also appealed to the full bench of the Andhra High Court, held that there was no necessity for the SSC to resort to the exemption under Rule 6, because in any case, the activity was outside the charge. And Rule 6 was only an understanding of the government to exempt the transaction. The understanding of the government cannot decide if there was an effective charge. And that question had to be answered only on the basis of the reading of the charging provision. Therefore, just like Rule 6, the notification which is presently issued by the government, treating it as nil rate, would be the understanding of the government of the position that it is perhaps a service and may not be determinative of whether there is liability or not, which has to be determined only on the terms of Section 9 read with Section 7 of the Act. So that's one part of it. Now, suppose one proceeds on the basis that there is, in fact, a liability on a slump sale, and therefore the exemption notification only exempts it from the payability of the tax. Then where do we stand? One proceeds on the basis that there is liability. Now, immediately the impact would be on Section 17, read with Rule 42. Now, Section 17, as we know, provides for apportionment of credit when in two circumstances. 17.1 and 17.2 are immediately relevant for our discussion. 17.1 deals with need for apportionment when it is used partly for business purpose, partly not for business purpose, and inputs. 17.2 when it is used partly for exempted service, provision of when it is used partly for exempted, partly not for exempted. So 17.1 and 2 are immediately relevant. Now, when one looks at the language of Section 17, now first of all, one may have to pose himself the question, is 17 read with Rule 42 at all conceived for a purpose when there is transfer of business at all, or it is intended operate only in the case of a subsisting business with two different streams of activity? So when one looks at Section 17, in 17.1, for example, we find the expression use. Use is an expression which is found in 17.1 and 17.2. We also find the expression partly. Use, the expression use and the expression partly may indicate that what section 17.1 and 17.2 have in mind is a situation akin to the erstwhile Rule 6.3 of the send-back credit rules. That is, a traditional situation of a business entity having exempted clearances in the subsistence of its business, exempted clearances and dutiable clearances. Therefore, 17.1 and 2, when they say use, they are not having in mind a situation that it ceased to be used. It also says partly, which means a parallel activity taking place. So 17.1 and 17.2 per se can lead to a construction that perhaps a slump sale was never intended to fall within the terminology of section 17 at all. That's reason A. Then we go to the rules. There's something interesting in the rules which provide for apportionment. I found that, which all of you may have, on going through, may also have noticed, but I thought I'll just share my thoughts. And section 7, rule 42, as you may have seen, provides for a principle of apportionment. And when one goes through rule 42, one finds that there is a formula. And the object of the formula is to reverse the credit which is attributable to business and non-business purposes, to find the credit which is allowable, and to transfer the credit to the electronic credit ledger. That is, in the formula, C, which is mentioned. C has to be indicated in the electronic credit ledger. Rule 42 also refers to a tax period. The tax period is the period for which the monthly return is filed. The monthly return is in form GSTR 3B. Rule 42.1G requires the assessee to report periodically every month the credit available in form GSTR 3B. Therefore, even if in 17, if there is an ambiguity, when one examines Rule 42, it appears to have a scheme in mind where in every tax period, there is a need to carry out a reversal of a subsisting activity and may not even contemplate a one-time activity like a transfer of business. So the scheme of Rule 42, which is designed for the purpose of Section 17, may itself not have in contemplation a one-time activity which takes place once in the lifetime of an organization as a slump sale. That is what I felt on reading of section 17 read with rule 42. The section read with the rules and the forms schematically appear to indicate a subsisting business with two parallel streams of clearances and use of inputs and input services for taxable and exempted activity. That's one part of it. Now, there's a recent board circular which came. Now, before I go to the board circular, I also thought one important, interesting question. Is it possible to retain the credit in spite of a slump sale? Is something which I thought we can discuss. So section 18.3, if one sees, recent board circular came in January, did not expressly deal with this question. It proceeded on the assumption that credit will go and can be transferred, and did not expressly deal with the question whether credit can be retained. So when one looks at 18.3, it says where there is a change in the constitution of a registered person on account of sale, merger, demerger, amalgamation, lease or transfer of the business with specific provision for transfer of liabilities, the said registered person shall be allowed to transfer the input tax credit which remains unutilized in his electronic credit ledger to such sold, merged, demerged, amalgamated, leased, or transferred business in such manner as may be prescribed. Therefore, the section 18.3 says shall be allowed. The language of 18.3 is not a disentitlement. It's more in the nature of a shield rather than a sword. Now, if credit per se is property, because the right to the credit vests under section 16 of the Act. Section 16.2 sets out the conditions for the credit. And once those conditions are satisfied by the assessee, the right to the credit will vest. So once it vests, 18.3 per se is not a provision which annuls the credit. It only says that we are allowed to transfer the credit, which begs the question, can the assessee be allowed to retain the credit? Now, in my opinion, it appears to be so, because 18.3 per se does not prevent the transfer of the credit, does not prevent the retention of the credit. It's more in the nature of a permission granted. Also, when one goes to the rules, the relevant rules which have been framed for the purpose of section 18 to permit transfer, which is the rule 41, which is framed for the purpose of transfer of credit. Rule 41 says a registered person shall, in the event of sale, merger, demerger, amalgamation, lease, or transfer, or change in the ownership for any reason, furnish the details of sale, merger, demerger, amalgamation, lease, or transfer of business in form GST ITC 02 electronically on the common portal, along with a request for transfer of the credit. So, Rule 41 also uses the expression request. It does not mandate the transfer of the credit. It is pursuant to section 18.3, which contemplates a permission for the transfer of the credit. Now, in a situation, therefore, if one proceeds on the basis that there is no express provision to annul the credit, which is granted in section 16, there seems to be no reason for retention of the credit by the transfer. Here again, I think possibly three scenarios can arise. I thought of three possible scenarios. I thought may be relevant. Scenario A, there is there is a single registration for a company. There are two lines of businesses in the same registration. One line of business is transferred to a third party. Can the credit be retained? When one looks at the provisions of the Act pertaining to registration, for example, and the provision, let us say, pertaining to input tax credit and electronic credit ledger, section 49, section 41, look to an electronic credit ledger for a registered person. Now, if the principle under GST law is that the registered person can be an entity by himself, then that registered person will have an electronic credit ledger in terms of section 41 and 49. That electronic credit ledger, when one examines the form GST PMT 02, it has broadly two columns, debits and credits. There should be no difficulty in, as long as the registration survives, the electronic credit ledger for the registration will survive to be retained and used by the retained business, because the principle appears to be that the credit is registration specific. That is scenario A. Scenario B, where a company has two registrations and there is transfer of one line of business to a third party, and there is an attempt to transfer the credit to another registration. Attempt to transfer the credit to another registration. Now, in that sense, is that possible? Can be the question. Now, the closest provision which is there is Rule 41A. Rule 41A looks at transfer of credit amongst multiple places of business, multiple places of a business. Rule 41A does not expressly appear to contemplate a situation which is what I mentioned as situation B, where there are two registrations for a company, one line of business being transferred, and the credit is sought to be transferred to a different registration of the same company, though the business has been transferred to a third party. 41A may cover a situation where there are multiple places of business for multiple places of business for a business, but may not appear to contemplate a situation as what I mentioned. Also, 41 capital A, Rule 41 capital A refers to a new registration which comes into existence. Therefore, I would assume that in scenario B, there may be difficulty in transferring the credit. Then comes scenario C. So scenario C could be a situation. Scenario C could be a situation where the SSC looks to transfers one line of business and looks to transfer the credit to a new registration. Now, this prima facie seems as though it's expressly covered by 41A. But if one examines Rule 41A, it looks to multiple places of business of a new registration. Now, therefore, unless the SSC therefore squarely falls within the terms of Rule 41A of having a separate place of business and a new registration for that place of business, it may not even be covered under 41A. Now, I would therefore proceed on the basis that in cases where somebody is looking to put through a slump sale, ideally placed will be a situation where a company has a registration and with separate lines of businesses. And in scenario A, where there are separate lines of businesses under a single registration, then retention of credit would be easiest, is what I felt. This is as regards the issue of retention of credit. Then, of course, the recent board circular on the 20th of March, 2020. Now, the board was concerned with certain questions. And answers accordingly given by the board. Situation A, 4 or 5 issues were considered by the board. A, first question was whether the asset-based formula, this formula which is set out in Rule 41, proviso, will it apply for all types of business transfers or it will apply only for merger? The board has clarified it will apply for all types of business transfer. This appears to be somewhat contrary to the express terms of the proviso to Rule 41, because proviso to Rule 41 appears to deal with the case, only with the case of demerger. Whereas the board has now clarified that this principle of apportionment can be used for every type of business reorganization. It's in the nature of a relaxation. The question can therefore be, can the department attack its own circular? Now, in 2008 Supreme Court, in Kurian Abraham versus State of Kerala, the Supreme Court put it in this fashion, that one role of the Board of Revenue, as it was under the Kerala Value Added Tax, is to clarify and interpret the law. The other role could also be to offer relaxations from the existing legal position, to offer administrative relief. Perhaps one can treat this as an administrative relief which has been given by the board. Then, another questions for the apportionment of credit, where the proportion of value of assets transferred should be determined at a registration level or entity level. Now, the formula which is being set out in the rule under the proviso to Rule 41, I'll just read the formula. in Rule 41A. Rule 41A proviso contains the formula. Proceeds on the basis that credit will be transferred. It says in the case of demerger, the input tax credit shall be apportioned in the ratio of the value of the assets of the new units as specified in the demerger scheme. So the question which was posed before the board is, would be entity-based proportion or registration-based proportion. For example, if a line of business has 2-3 registrations in different states, because, for example, there's a factory which manufactures motor vehicles, two-wheelers, motor vehicle division, cars can be an independent division, and there could be factories in different states. Board has clarified that you apply the formula on a base of registration to registration basis and arrive at the credit. Now, as regards this issue, now one question can immediately arise for the purpose of applying the formula. The company itself may first have to maintain a balance sheet unit-wise and arrive at the value of the assets. Because for the purpose of applying the formula, the value of the assets of the individual division and the gross value of the assets, both are required for the purpose of applying the formula. So to arrive at the value of the assets of an individual division itself may be a cumbersome task. But the board has permitted it, and to effectuate it, one may need to arrive at the value of the assets of the individual divisions. This is one part of it. There could also be certain assets which, for example, which can cut across divisions. For example, software. So software which is maintained in a centralized place may not be division specific. It could be applied across various divisions. In which case, how to apply it registration wise is an issue which can possibly arise. Therefore, in respect of common assets, how to go about applying the formula contained in Rule 41A can be a question. That is issue number 2. Issue 3 is that when it comes to related party transaction, suppose it's intergroup transfer which is taking place, related party transaction. What is the method of valuation to be applied? Department may needlessly go to the valuation rules for the purpose of adopting a principle of valuation from the valuation rules. But in my view, that may be misconceived, because the purpose of this valuation is not to fix a measure for the supply, but to arrive at the quantum of credit to be reversed. Therefore, what's the value to be adopted for the purpose of the formula? Is it, for example, the book value of the asset? Is it, for example, the market value of the asset? Very often, independent valuers are appointed. So, what principle of valuation is to be adopted for the purpose of valuation is a question which can arise after the board circular. Yet another issue is, where should this form be filed? Board has clarified that you can file the form in ITC 02 in a place where both the transferor and the transferee are resident. Now, there could be a situation where the transferor can have a factory in state A and state B. The transferee can have a factory in state B. So, in such a situation, if I am compelled to file the form ITC 02 only in the state in which the transferee is located, how do I transfer the credit from the state where the transferor has a factory, but the transferee is not located? So these are, or should we understand the form ITC 02 only as part of the machinery provisions? Because it's only part of the machinery provisions, my substantive right to transfer the credit under 18.3 is not lost. Therefore, the form ITC 02 and the procedure which is set out by the board circular is only procedural in nature and will be subservient to section 18.3 of the CGST Act. These are broadly, I think, some of the issues which arise as regards slump sale under the GST regime. I've attempted to cover what I thought was relevant. I think this is broadly what came to my mind, which is possibly relevant. And I will now leave it to the floor. And if you have any thoughts, please go forward.
Thank you, sir. Now the floor is open for discussion and queries. So if any of the participants have any queries or any points to supplement or to add, you can kindly raise your hands in the app, and or you can drop in your thoughts or messages in the chat box. First, Mr. Ashokan, I'll unmute. Mr. Ashokan.
Sir, you are able to hear me. Sir, good evening, sir.
Yes, sir. Yes, sir. Yes,
sir. We have one small situation, sir. See,
Yeah.
there is one company.
Yeah.
It is a private limited company.
Yeah.
It is an existing company. It's going on concern. They intend to demerge two divisions of their operations.
Okay.
But at the same time, they intend to retain the land and the building, and they propose to demerge A and B separately, and the two companies will be a private limited company.
Right, got it. Yeah.
So I do not know, but they were telling me they have gone to NCLT. Is it mandatory to go to NCLT?
All right.
Achha, we do not know the intricacies. Initially, he has told.
Okay.
So now that is also 100% EOU, basically.
Yeah.
Right. And the proposed demerger of two separate independent companies is also proposed to be a EOU. Now they do not want to pay anything or ITC and all those things. How to take it forward, sir?
Now, as far as liability is concerned,
okay,
you're saying land and building will be retained.
Retained, and they propose to charge and collect rent from the two separate companies.
I see.
Yes.
Okay. Which means the land and building will be used. It will be used for a rental activity.
Yes.
Now, will be used for a rental activity, and it will actually be used by the entities which have been demerged.
Yes. Yes.
It will be used by the entities which have been demerged.
Yes, sir.
Now, is there any other business which this company was carrying on? Any other manufacturing activity or anything else?
No. Now, existing is one company. It is a EOU. Okay. It is a foreign company, basically based in.
What we can say is this. Sir. You see, the one judgment of the Supreme Court. There's a judgment by the name of K.H. Chambers.
Okay.
It's an income tax case. Commissioner of Income Tax was K.H. Chambers. Now, fairly old judgment of the Supreme Court, and the judgment appears to lay down this principle: to constitute a business succession, it is not necessary that every part of the business needs to be transferred. That's principle A. Okay. Now, if something is retained, there's no problem. But the crucial test will be this: is the retention to carry on the business? To carry on the business which is transferred? Is the retention being made to carry on the business which is being transferred, or the retention is being made to ensure that the transferee is not burdened? That's the question to be posed in these matters. Now, when one examines this, or when one examines this situation, now it may look ostensibly as if that let us say there's a manufacturing division which has been hived off. Yes. It may look ostensibly so that the retention is not to carry on the manufacturing activity. So it may not, on the prima facie on the application of the test in this K.H. Chambers, it may not prejudice the position. But because they appear to be related, question can arise whether this is the retention that because there is an exploitation of the land and building for a commercial purpose Is there a complete business succession could be the argument of the revenue. The defense, I think, will arise, can be put on the basis of KH chambers and a submission can be made that I am retaining the land and building, not carry on the manufacturing activity. If I retain the land and building for myself to carry on the manufacturing activity, the use of the raw materials which I procure at my cost, then there is no business transfer. But I'm not retaining it to myself carry on the manufacturing activity, but somebody else is doing it. Therefore, there continues to be a transfer of business, is perhaps an argument can be put. And therefore, for the reasons which I mentioned, no liability.
Achha, but you in Schedule 2.4 it says there should be a seizure of business. But he doesn't cease to be in the business. He continues to be in the business by way of renting of immovable property, by land and all those things. In that situation, I think he is required. It is not covered.
He ceases to be in the business which he transferred.
Achha, you have to distinguish that way. Okay.
He ceases to be in the business in which he transferred. He may have commenced some other business, but he ceases to be in the business which he transferred. And therefore, if a line of business itself is capable of transfer, I have not retained the asset to carry on that business itself, which I have transferred. I have retained the asset to do something else.
Achha. Okay. But the GST law is not like that. Means there is no distinction between goods and services as it was earlier. Now the RC is same.
That's true. That is true.
Okay.
And therefore, one can possibly conceive business as a service. That one must be prepared perhaps to conceive.
Okay.
But the larger question will come, even if one concedes it to be a service, is it supply under Section 7?
Okay.
That's the thing.
Okay, sir. Thank you for enlightening, sir. It was a very nice discussion. Thank you so much. Thank you.
Next, I would unmute Gokarnation, sir. Gokarnation, sir.
Hello.
Yes, sir. Good evening.
Am I audible, sir?
Yes, sir. Please. You're audible, sir. Please. Good evening, sir.
Hello.
Yes, sir. Please.
Hello.
You're audible, sir. You're audible, sir.
Am I audible, sir?
Yes, you're audible. Absolutely audible.
Hello.
Yes, sir.
Good to hear you, sir.
I'm audible. Am I audible?
Hello.
Prasad, sir, even you're audible. But I think Gokarnation, sir, you're audible, sir. We can hear you. We'll try again. Gokarnation, sir, are you able to hear me? There seems to be some problems, sir. In the meantime, we'll go to the next question by Rohan. Rohan?
Hello.
Yes, Rohan.
Yeah, good evening, sir. I think the proposition that you laid out on whether it's a supply is something that I think we can all consider. I think, and the decision of Paradise seems to be on the very same point. So that is something that we can definitely consider. My question was slightly on a different issue. So the slum sale can be a contractual transfer or a court sanctioned transfer, in the sense that if it's a demerger, merger or amalgamation, etc. Now, as we all know that in case of a court sanctioned demerger, that will flow from an appointed date, which will flow back in the past. There is a court order and there is an appointed date. Now, what happens that, let us take a case of a credit transfer. For a credit to be transferred by a supplier or a transferor, the transferor should be in existence in first place.
Absolutely, yes.
Whereas in case of a court sanctioned transfer, the transferor will not be in existence from the day which is preceded, as in going back also.
It can be retrospective also.
Correct. So do you think there is a conflict in that sense, because there is no transferor in first?
There is. There is, because that's one of the issues which is left unanswered by the board. The board in this March 2020 circular, if you notice, for the purpose of quantifying the credit, it says take the appointed day as per the Companies Act.
Correct.
Now, there could be two dates. There could be a transfer date in the scheme. There can also be a final date on which all the approvals are completed.
Right.
The transfer date, if it is sanctioned, I can apply today, let's say on the 1st of April. But on account of the sanction of the court, I can cease to exist on the 1st of April. Therefore, that issue certainly survives. And therefore, I would assume that in matters of this sort, a balance has to be hit. Now, there is an anxiety on the part of people to ensure there are various inputs for which credit is in the pipeline. Suppose I decide to transfer the credit today. There are whatever inputs which are lying in stock, I can take a decision and say this is the quantified amount. But which there are inputs in the pipeline, I may have to wait and then ensure that the inputs which are in the pipeline are received, then formulate the scheme with a transfer and an appointed date if one is anxious about the credit. Because the board circular says as per the Companies Act. So what does it mean? Does it mean the transfer date as sanctioned by the court? Or does it mean it says the appointed date? Now, appointed date would be the date on which all approvals are completed. Now, this is something which has been left open for debate. Now, when the approvals are completed, it will take a couple of years. But going by the principle laid down in Marshall & Sons line of judgments, if it's retrospectively effective, then on the date I apply, I cease to exist, as you pointed out.
And if I extend the logic of Marshall & Sons, then let us take a case of demerger. Then is it that the new entity has to pay taxes for the last 2 years? Because for a merger, there is a deeming fiction, a merger and amalgamation saying that it will not go back to the original date in section 87. Whereas in case of a demerger, wherein something comes out, there is no deeming fiction to overcome Marshall & Sons in that sense. So there is a difference. Just wanted to discuss on that. Thank you.
Absolutely. Right.
Thank you, sir. We'll again try with Gokarnation, sir. Gokarnation, sir, are you able to hear us? Gokarnation, sir, am I audible? I think there is some technical.
Hello. Now I am audible?
Yes, yes, you're audible, sir.
Something wrong.
Sir, you're audible.
Hello.
Sir, I think he's not able to hear us.
Not. Hello.
Okay.
Okay, leave it, sir.
Sir, I think Vishwanathan sir also put up something in the box.
Yes.
Vishwanathan sir, kindly unmute.
Yes, what is it?
Sir,
Right now we're asking. See, I only put that 41A, there was no support from the Act, was my understanding. The 18.3 doesn't support 41A, is my view.
41A seems to be a kind of a relaxation. 18.3 per se covers the situation of transfer of the credit, transfer of the undertaking. 41A seems to be something larger.
But whether it is covered under 18.3 is the question.
I will just go back to 18.3. 18.3 says where there is change in the constitution of a registered person on account of sale, merger, demerger, amalgamation, lease or transfer of the business with specific provision for transfer of liabilities, the said registered person shall be allowed to transfer the input tax credit which remains unutilized in its electronic credit ledger to such sold, merged, demerged, amalgamated, leased or transferred business in such manner as been prescribed. So this contemplates a transfer of the credit to the transferred entity,
Subject to constitutional change or merger.
Correct. And also, it appears to contemplate a situation where the credit goes with the business. The credit goes with the business.
Goes with the
Yes.
business and the liability.
Absolutely.
Liability also undertaken.
Sure. But 41A is interstate.
Inter-unit transfer.
Absolutely.
But
In
that is not
that is true.
Act.
But 41 is what is seen.
That permits no dispute.
It's closer to 18.3. 41A is wider.
Yes. Thank you. Sir, I call upon Natarajan sir to carry forward. Natarajan sir.
Yeah. Good evening, Prasad.
Good evening, sir.
Good evening.
Yeah, good evening, sir. Good evening.
Actually, not a question. I have been just asked to summarize. See, day by day, when we do more and more topics on GST, we come across that still there are lot of issues which will be definitely going to be taking the future time to settle down. And this slump sale, we can also use the expression transfer as a going concern, an accounting term. So it's also one of the issue where there are a lot of doubts. We have to interpret a lot. And unfortunately, we don't have any much of jurisprudence under GST except some advanced rulings. And fortunately and very strangely, even the 2-3 judgments available on advanced ruling, they are all in our favor and saying that it is exempted, it is not liable. That is very unique of the advanced ruling authority, including the
I also wondered whether it was given strategically to ensure there's credit reversal.
Yeah, considering the track record of advanced ruling, it is really path-breaking decisions. See this, just to put it in a nutshell, the transfer of a going concern is giving the business as such to a new person who will carry on the business in his name. There will be no discontinuity in the business. So in that case, now as per your, you have dealt with exhaustively under the S2L regime, sales tax, VAT and all. It has always been the policy of the government not to levy any taxes in case of transfer of business as a going concern. So we have to go by that particular time-tested principle that transfer of going concern is not liable to GST also. There may be problem because exemption is given only for services and the law is silent about the goods and all that. The reason being, once it is a transfer of going concern, the entire activity is declared as a service activity under Schedule 2. Even though goods may be involved, stock may be taken up, but by virtue of a deeming fiction, the entire activity is treated as a supply of service and it is exempted by the notification. But still, how far the department will be clear, still they may try to segregate between goods and services, all these issues which we are going to face. And you have whatever judgments you have referred to in the VAT regime and sales tax regime, and including the recent one by Andhra High Court, Paradise Hotel. Really, they are all going to be the paradise of lawyers. We have to read all those judgments very carefully to deal with this particular issue. And thank you for this enlightening session, Mr. Prasad.
Thank you so much for the opportunity. I thank the Madras Tax Bar for giving me this wonderful opportunity to interact on this. I also feel, as Mr. Natarajan expressed, it will be something of tremendous significance in the coming years. This particular topic, especially on the credit issues and transfer of credit, what I personally feel. Thank you so much, all.
Yes, thank you. Thank you, all the participants. Over to you, Priti. You can close the session.
Thank you very much, Natarajan sir, and thank you, Prasad sir, once again for this talk, which is of significant importance. And I thank all the participants for joining us today for our 120th webinar. Tomorrow we will be having a special webinar jointly held by the Madras Tax Bar as well as the Madurai office. The session will be by Honorable Justice Mr. Vaidyanathan. His talk will be on from his education to where he is attained judgeship. Tomorrow is his lordship's birthday also. So I request all of you to kindly join for tomorrow's session as well at 5 p.m. I've already shared the link in the group. We will be resharing it again. So thank you once again all for joining us today. The session will be uploaded in our YouTube channel as well. So take care, stay home, stay safe, have a good day. Thank you.
Thank you.
Thank you.
Thank you.